After analyzing thousands of my own losing trades, I discovered something wild. Every single losing trade, and I mean every single one, falls into just 5 categories. And once you know what these 5 categories are, you could eliminate over 80% of your losses overnight. And the 5th category is probably the most important. So if you want to finally understand why your trades keep failing, stick around and watch until the end of the video. What I'm about to share with you might just change your trading forever. Let's get into it. Now, the first one on the list is direction. And I'm not just talking about whether you want to go long or short. I'm talking about whether you understand the actual trend of the market that you're trading. The reality is that if you're fighting the trend, you're fighting the market. And the market always wins. I used to think that I was smarter than the market. I would see a stock that is rising, and I would say that this stock cannot rise no more. It has to come down. It's gone too far. So I would short it. And guess what happened? It kept going up and going up and going up. And I kept losing money. The direction question that you need to ask yourself before every single trade is this. Is my trade in the same direction as the trend and my bias, or is it against it? Alright, so this is a recent trade that I took just a few days ago. This was a 2-hour trade and it took roughly about 7 hours to complete. Now, some of my trades might be a few minutes long, some might take a little bit longer, but regardless, the concept of every trade for me is the same. The first one obviously is the direction of the trade, right? I want to see what is the trend. And looking at this chart on a 30 minutes, we are clearly in a downward trend, right? Each of these candles is a 30-minute time frame, and as you could clearly see, we are setting a series of lower highs and lower lows, right? We have a lower high here, lower high here, lower high here, lower high here, lower high here. You could clearly see that we are in a downward trend, right? It's very, very obvious to us. I obviously want to be looking for shorts if I want to go with the trend. So that is my direction of the trade. Before your next trade, ask yourself, am I trading with the trend or against it? If you can't answer that question clearly and confidently, don't take the trade at all. It's that simple. Now, the second category is location. Location is all about where you're entering the trade. And this is not just any random place on your chart that looks good. And the location question that you need to ask yourself is this. Am I entering the trade in a high probability zone? Or am I just entering the trade because it looks good or I'm bored and I want to be in this trade? High probability locations are places where multiple factors converge. Maybe it's a support level that's been tested multiple times. Maybe it's a break below previous day low and a failed break retest of it. Maybe it's a liquidity grab right off the session VWAP that's been respected. Or perhaps a breakout from a consolidation area. There's so many different ways to go at it, but the most important thing is that the location of your trade is not just some random place on the chart. Where you enter a trade is extremely important. The best traders that I know are incredibly picky about their entries. They'll wait hours, sometimes even days for the right location. For me, I know that if the location is A+, if the trade reverses and it hits my stop loss, my whole trade idea is invalidated. That area becomes your safe zone and you feel confident in that area and you could hold your trade for minutes, hours, even days, depending on what kind of a trade you're taking. Now, the next thing that I'm looking at is for my trade to be at a good location, right? I want to be entering the trades in a good area. And as you can see, the level that I was looking at is the previous day low right over here, and watching how we react around that level. Now, any indicator for me is just a secondary confluence. When I'm actually analyzing and setting my levels, I like to do it without any indicators. I like to look at just pure price action. And the most important thing here, again, I was looking at was the level here of the previous day low. So then that was my location. And on top of that, I saw that we have a downward session VWAP. We have the 9 SMA right there. So this combination gave me a great location for the trade. So when I'm taking the trade here and I'm putting my stop loss right above it, I could be confident in the location of that trade. So not only do we have the direction in this case, which is the trend is down, but we have the location, which is an entry right below the previous day low. And on top of that, we have the VWAP, the 30-minute 9 SMA right there. Everything is nice and tight right there next to each other. We have a great location. So before you press that buy or sell button, ask yourself this. Is this a high probability location, or am I just entering the trade because it looks good and I want to be in a trade? Your account balance will definitely thank you for being honest with that question. The third category is destination. Now, most traders spend all their time thinking about where to enter a trade, and they never really think about where they're trading into. And it's kind of like getting into Uber and not knowing where you're going.
I need an address.
We must travel in that direction.
Sounds silly, right? And in trading, that becomes a massive mistake. When I talk about destination, I'm asking, where is this trade going? And what's waiting for me there? Are you trading into a major resistance level? Are you targeting a liquidity zone where a bunch of stop losses are probably sitting? Or are you just hoping that the trade's gonna work out and you're gonna figure out your exit later? And hopefully it's not the last one. Now, the next thing that we need is the destination. Where is the trade going into, right? Where are we targeting? We see that we have one level here, which is a 4-hour swing low right over here. And we have another 4-hour swing low right here. And then we have another swing low right there, right? So what I was looking at during the trade was how we are going to be reacting around these higher time frame swing lows. Now let's look at how the trade actually played out. So as you can see, again, this is the 30-minute time frame. And when I'm entering a trade on a time frame, I like to also manage it on the same time frame. So in this case, the trade was entered on the 30 minutes. So I'm going to manage it also on the 30 minutes, meaning every 30-minute close, I'm taking a look at this to see how the levels are looking, right? So here, pretty nicely, we had a whole trend for the whole day down. And once we came down to the swing low that I was looking at, we crushed through that level and started holding that as a resistance, right? You could see these wicks right over here. So this was showing me that we had a little bit more room to go down. And as you could see here, I ended up taking the trade out here at TP. And obviously we never know how much longer a trade could go, but I was pretty happy with this. And this is a clear example of a trade that had direction. I entered at a good location and I had destination. I had liquidity levels that I was targeting. And the beauty of a 30-minute trade is that once I'm in the trade, I'm not going to mess with it until I see a 30-minute close. So it means that during the trade, no matter how this candle was looking, I would not touch it because I entered the trade on the 30 minutes and the only decisions that I'm going to make are on 30-minute closes. So if we had, for example, a very bullish candle that closed right here, then I could decide to close that trade because we have a very strong 30-minute close right above the liquidity level. And that shows me that this strong candle, more likely than not, will have continuation upwards. So at that point, I could choose to close that trade. But that didn't happen, right? As you can see, every 30-minute candle, once we were around that swing low level, was basically a weak candle. We have wick, we have wick, we have wick here, we have wick here. And it's true that during that 30 minutes, it's possible that the candle would look something like this, right? But the beauty of not messing with your trades is that when you enter on a trade on a 30 minutes, you have to make sure to look at it on a 30-minute close. And that by itself avoids me from making psychological errors because my rule is that I make decisions on the close of my entry time frame. So this is where the psychology part comes in. During this whole trade, I really had no reason to close it. And my stop loss was at a very safe spot because if for some reason the price came back, let's say over here, and it closed right here, my whole trade idea is invalidated. So before you enter every single trade, identify where the next major liquidity zone is in the direction that you're trading. And that right there is your destination. If there's no clear destination within a reasonable distance, maybe that's not a good trade to take. So those are my 3 criteria for every single trade that I take. My trades need to have a direction going with the trend. It needs to have a destination, a liquidity level that I'm targeting, and I need to enter at a good location. Now, if you're following all of those 3, there are just 2 other categories that you need to keep in mind. And let's talk about that now. Category number 4 is psychology. And this is where most traders, myself included, even to this day, have sabotaged more good trades than we want to admit. You could get direction, destination, and location perfect, but if your psychology is messed up, you're still going to find a way to lose. Now, there's so many different psychological mistakes, but some of the most popular ones are moving your stop loss when the trade is going against you. Now, that's fear. Taking profits too early. Again, fear. Holding on to losing trades because you don't want to admit that you were wrong. And entering trades emotionally instead of waiting for your setup, which is FOMO. And these are all very common psychological errors that all traders pretty much make. And these never truly go away, but over time, you get better at managing it and noticing it and putting right protocols in place to avoid falling into those traps. And all of that really comes with chart time and practice. And one of the biggest things that really helped me with this is not to mess with a trade once I enter it. And that's one of my biggest rules. If I'm following the three things, again, direction, destination, and location, and my stop loss is in a safe place where if it gets hit, my whole trade idea is invalidated, then I don't want to mess with that trade. If there is a little bit of retracements, if the trade's taking several hours, I'm not going to jump in and mess the trade up. And for this same exact reason, I've been in trades where it took a few minutes and my target got hit real fast, or I've been sitting on trades for 9+ hours for it to finally hit my TP. But the key thing here was I did not just step in and mess up my trade. The market doesn't care about your emotions. It doesn't care if you're scared, greedy, desperate. It just moves based on supply and demand and liquidity. And your job as a trader is to execute your plan and strategy regardless of what you're feeling in the moment. So with every trade, you need direction. What is the overall trend? Location, where are you entering the trade from? Destination, where is your target and liquidity zones? And once all that lines up, psychology is what keeps you from driving off the road and messing things up. And if all of those 4 categories check off, then it's just the probabilities that didn't work out. And I realized that it is that simple. So what I recommend here is that after every single losing trade, categorize it into one of these 5 categories and keep a simple log. It doesn't have to be anything complicated, but as you're journaling and reviewing your trades, also have a category where you put down what category that loss falls into. And after a month or 2, take a look at that log, and then you're gonna start seeing patterns. Maybe 60% of your trading losses are from psychology. Maybe 30% of your losses are from location. Whatever that pattern is, that's where you could put your focus and improve in your trading. The goal is not to prevent every single loss, but it's to eliminate the preventable losses. And as much as you can, you want to aim for that losses to be a probabilities category. I've been using this exact same framework for over 2 years now. It has completely transformed my trading. I went from losing money consistently to being profitable. And it was not because I found some magic indicator or a secret strategy, but it was because I stopped making the same mistakes over and over again. Alright guys, I hope that you enjoyed today's video and you got some value from it. If you did, smash the like button, share it with somebody that you think will get value from it. And if you haven't subscribed already, what are you doing? Subscribe to the channel, join the family. We are on our way to 1,000 subscribers and I would love to have you on that journey with me. I look forward to seeing you in the next video. See you next time.